Okay, so I wanted to just throw this lesson in here because at the time of me recording this lesson now, I have actually pretty much finished all of the Liquidity 3.0 lessons and also the putting it all together 3.0 section that you're literally just about to start. But since I've done all of that, kind of two things. One, I don't think when I look back, I made it clear enough this part here on the entry model, okay? So when you go through the putting it all together, it probably becomes a lot more obvious in the actual trade examples. But we're gonna go through this now. I'm gonna really kind of drill the importance of this into you. And then also kind of what I think the common sort of mistakes will be, and we'll kind of go through that here. So essentially, within all these entry models that you've just been looking at in the previous theory lesson, what we've been saying is looking for where the liquidation occurs. And then what we're calling this is the PBL, the point before liquidation. Okay, so you've got another acronym to add to your toolbox, but it will really help to make this clear, okay? Because this thing is major key to the idea of what we're doing here to these entry models, okay? So basically, when you get that liquidation, so this is when we had the higher time frame leg to the left, you want to look for where was the zone. So if it's supply in this case, because we're bearish, where was the zone that caused that liquidation, right? The point before liquidation. That's what we're going to call it. And that's what you want to see get flipped, okay? Or at least fail, okay? Because sometimes it won't be a flip, it'll just be a moving up, and then you can look for the entry down here, okay? So we're always looking for the PBL to fail, the point before liquidation, likewise here, right? So if price comes down, gives you a chock. Yes, we've had a liquidation. Yes, maybe you've got an entry, but the PBL hasn't failed yet. So this is why you don't want to take this, because what happens is a lot of people go, oh yeah, I've got a liquidation now. Now I've got a chock. Now I've got an M1 demand or whatever. Now I can get long, and then it just keeps going. Because what you want to see is this go, and I'm going to talk about this in the next slide so we can make this a bit clearer. But essentially, going forward, this level here is what we refer to as the point before liquidation, right? The zone that causes the liquidation, and we just refer to that as PBL. So you're about to watch a ton of trade examples in the walkthroughs in the next section, in the putting it all together 3.0 section. But when I recorded that, I wasn't referring to this with the name of PBL. I just called it, the supply that caused the liquidation, just so you're aware. But going forward now, we'll be consistent. We'll call it PBL, okay? So kind of the common mistakes, we'll go through these one by one. And again, I want to caveat all three of these. It's not that you can't trade these scenarios that we're about to go through. It's just that when you're starting off, be super mechanical and strict with the rules that we're giving you. And if you want to be trading those liquidity entry models, then these are invalid if you are trading those models, okay? But that doesn't mean that you can't take these trades. It's just you need to realize it's a different setup, and that's something that needs to be in your plan if you're allowed to. Okay, but that'll make sense as we go. So let's start off with the first one. And this is basically where the point before the liquidation has not yet failed. Okay, so imagine you have your higher time frame zone. You're waiting for it to be obviously mitigated because you can't look for an entry until it's been mitigated. And you want to wait for a strong liquidation, right? So you need to see that strong liquidity built. So it's built here with the equal lows. Price then liquidates those lows and we get the higher time frame mitigation. If you're looking for the liquidity entry model, your job is to then identify where was that point before the liquidation, okay? Now, what you may want to do is always take the nearest zone, right? So where that liquidation occurred, price breaks it, look for where is that nearest point before liquidation, the nearest supply zone, okay? So whether you want to use a pivot zone only, so you need to look for like an actual candle, right, that caused the break, or if you're happy to use fractal zones, so you have like buy to sell wicks, that's down to you, okay, and be more aggressive. But always look to take the nearest zone, okay, and we'll talk about this more in the pivot zones versus fractal zones in the walkthroughs, because obviously fractal zones is a lot more aggressive, right, because that would just be one straight push down and all you would see is that buy to sell wick supply, okay? But typically you want to try and be as consistent as possible and always take the nearest zone, okay? So when we get the higher time frame mitigation down here, we've seen the liquidation up here, okay, and then you identify your PBL zone. Now, what happens if price comes down here and then gives you, maybe even get a chock and a flip or whatever? Do you want to take this? Well, this is what I'm saying. If you are following strictly the liquidity entry model, right, for strong liquidation, I think this is liquidity entry model 2B equals, you need to see this go first. This needs to fail if you want that, okay? So this would not be a valid entry because the reason why, right, I'll tell you the logic because it can kind of help you to understand more is, what's the theory behind what we're doing here? Well, we're looking for big institutions to be stepping in and getting long. Okay, so if they want to get long, what do they need? They need sell side liquidity to reduce their slippage. Where is the available strong liquidity? It's below these lows. Okay, so if we're saying, okay, it's there and it's been built for the BFIs to get long, how do we define if they've actually used that to get long? Like, what would be a significant thing? Well, this is our mechanical solution. We look for the PBL to break, right? So the supply that causes a liquidation, we want to now see, has enough demand stepped into the market to actually, one, cause that to fail, and then two, if it flips it, then that's the level in which you want to get long. Or if it's just a straight push, right, you can look for the movement down here. Okay, so in this instance, we've got the liquidation, prices come in and potentially giving you a chock and a flip or whatever, but this hasn't failed just yet. So if you're looking for that entry model, you need to wait for this to go, otherwise this is an entry. Now I've said here, right, you still might want to take this. This might be an entry model you want to test, but again, it's not the liquidity entry model that we're giving you, okay? So you want to kind of be strict with those rules when you're starting out. If this is something you want to add into your plan, fine, happy days. But again, if you're looking to trade that entry model, this would be invalid, right? So yes, then the second one will be where, again, same thing, you get the liquidation of the lows, you identify the point before liquidation with the nearest zone that caused the liquidation. Now, when price comes down and pulls back, we haven't had a chock, even if we've had the mitigation, that supply then holds, right? The PBL holds, and then the PBL does its job and it breaks the low. So this supply has now been used, okay? So remember when I said back here, what was the idea that we're trying to do? We're trying to see, do BFIs use that sell side liquidity to get long into the market? Well, if there was the sell side liquidity available here, price then taps into it, right, into that available pool, and it uses those orders. And then what happens? Then it fails to break the PBL that caused the liquidation, and then the PBL does its job and causes a break of that low. Well, then this PBL has been used, the supply has been used. So at this point here, when you see the break of that low, if, and this is a big if you are trying to use a liquidity entry model, and you need to see a strong liquidation before you're happy to get involved from this higher time frame POI, then you need to see it all over again. You need to start from scratch. You need to see new liquidity be built down here, because this liquidity has been used, the PBL held and did its job. So now you need to almost forget about all of this and you need to see it happen again. If you want the strong liquidation, right? You need to see the entry model again, right? So you need to see those equals, the PBL fail, the chock, and okay, and now you would have it. Again, if you need to see the liquidity entry model in this POI, right? Because then what can happen is you can get the PBL has been used, no new liquidity is built, then we do get a break of structure to the upside, and then, this could potentially be an entry, but it isn't. It's invalid, as I keep saying, and I'm repeating myself, it's invalid if you are looking for a strong liquidation from this POI. That would not meet that criteria, okay? So again, I'm not saying that this would be a trade that will fail or you shouldn't take. It's just, if it's in your plan to only look for a strong liquidation in that scenario, this does not technically meet those rules, okay? So I said here, right, this can make you miss trades. So it really depends on how strict you want to be, okay? So as you get more experienced and as you get more advanced, allow yourself potentially to have a bit more leeway and go, right, we've come into the extreme strong swing low. This is the last place that has to hold. Like, we've literally mitigated the extreme. We've got a ton of momentum. Like, everything looks great. Okay, there was some liquidity built here. Okay, it's not quite the exact entry model that I need, but I'm happy to get involved here. Okay, but don't do that when you're starting out. You want to be super, super strict and mechanical first, and then maybe bring in a bit of discretion in later. And the reason why you want to do that later is because it requires experience to know when this high time frame is good enough to want to get involved without your exact entry model, okay? So when you're starting out, I'm going to keep repeating myself because I need to drill it in. These liquidity entry models, if you're testing those and they're in your plan, be as strict as a robot. And in this instance, this would not be a strong liquidation because the liquidity was already used and it failed to achieve anything, right? So if you were waiting for strong liquidation, you would need to see it be built and swept again, okay? Hopefully I've kind of made myself clear there. And then the last one is when there isn't a chock, okay? So same situation, you have a liquidation into your high time frame POI, you look for the PBL, right? The point before the liquidation, the nearest supply zone that caused the liquidation. Now this would be an example, like I said, where if you use fractal zones, so when you have like buy to sell wicks, when there isn't actually like an actual structural pullback, it's just buy to sell wicks, and that gives you a buy to sell wick supply. If this is in your plan to use that as a valid PBL, because some of you might only use pivot zones, but if it's in your plan to be more aggressive and to use buy to sell wick PBLs, right? What could happen is the fractal high could be all the way up here. So when you get the liquidation, higher time frame mitigation, and then you get the PBL fails, so it's failed here, and let's say you get a flip or even on the extreme, potentially there's an entry here, but you haven't had the chock yet, right? So that would be invalid, because what we recommend in those entry models is that you wait also for a chock, okay? So again, when you get way more experienced and way further down the line, this may be an entry model you may want to start to test, because it's a lot more aggressive. Because yes, you've had the liquidation, hard time frame mitigation, and you've had the PBL fail, but you have not had structure shift in your favor yet. So this could literally just be this to come into this high and continue lower, right? And then you get liquidated. So this is why I said down here, this is a much more aggressive entry model, as the fractal structure has not shifted in your favor yet. So like I said, you might want to test this out, but we strongly advise that you start off by always at least waiting for a chock, okay, before you can look for the entry. So a common question I think I'll get is, when does the chock have to occur, okay? So once you get the liquidation, at any point after the liquidation, the chock can occur. So you might get the chock down here, right, like we did back here, and that's fine, but right, at that point you've got the chock, but what don't you have? You don't have the PBL fail. Once you then get the PBL fail up here, then yes, this would be a valid trade, okay, because you had a chock down here, right? So that's valid. If you need the chock, that would be valid. If the chock happens here, then the PBL's failed. Okay, now you can look to get involved. The other way in which it could happen is like, you know, the chock could be up here, right? And then you get the chock up there. Okay, now you've had the PBL fail and the chock again in. So it doesn't matter in which order it happens. It's just from after the liquidation, as long as there's a chock and a PBL fail, then you can get involved. But in this instance, all you have is the PBL fail. There's no chock, okay? So that would be invalid. But it may be something you want to add in much further down the line, because there are times when the chock can be really far away, and I've seen this play out. At the time of recording, I didn't test this properly, and I don't have hardcore data on it, so I'm not trading that way, and I especially advise you don't on it. But if you're watching this and you're a lot further along in your journey and you're consistent already with using the liquidity entry models we've already spoken about, then this may be something you want to add into your arsenal in specific scenarios, okay? So we watched this a few times because there's probably a few little points there that may initially go over your head. Come back to this lesson. A lot of times I'm sure going in the months and years forward, I'm going to be referring people back to this video, and hopefully this will help a lot. Now I appreciate if you're going through these lessons for the first time, we've done a lot of theory, a lot of line diagrams, and I massively appreciate that. But the putting it all together section that you're now about to watch should be a ton of examples in there. And then just keep coming back to these lessons, and it will help you hopefully going forward. But as of today, these are the rules that I've looked at and tested, and I really do believe that this will help you to be consistent, be mechanical, and be strict. And hopefully I've shown you here the logic behind what we're doing and why, and then that can help you to understand when maybe you want to either bend the rules when you're more experienced, or add in something that's like an additional entry model, i.e. here, okay, the liquidation didn't do its job, it didn't cause the PBL to fail, but perhaps because you've seen at least some liquidity built, and then you've seen a strong entry model and blah, 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 you may still want to get involved. But for now, that is not valid for you, okay? So I won't talk about kind of how you can make it more advanced for now, because it will just bring unnecessary confusion. Let's dive into the putting it all together module, and we'll go through tons of examples and just keep referring back to these diagrams. And yeah, hopefully it should help. So let's take a look at an example on the charts. And I think this one is, well, yeah, a really good example of how you can easily get caught out if you don't have the deeper understanding that we now have, right, with these liquidity entry models. So not going to go too in depth in sort of the setting up the higher time frame idea, but essentially we are bearish on the 4-hour chart. We've had a swing pullback and another break of structure just about. So we're now trading within this 4-hour range. Not the most convincing breaks of structure, right? And we've had that bullish 4-hour chock. So likely we can start to play that swing pullback up into premium levels of supply. If we jump down to the M15, interest of time, I have drawn on our swing structure, but essentially that was our M15 break there. And then we had the 4-hour break down here. So the swing range we have for the M15 is this low here and this high up here. After those breaks of structure, what's a really good sign that the swing pullback may be starting? Well, we can see that internal structure break. And if we look here, right, we had that bearish internal order flow in that structure, and now we've had a clear bullish IBOS to the upside. So now, because we have that, it's, well, I don't want to say very, but pretty damn high probability, right, with the frameworks that we use to start to play that swing pullback, right? Where this now becomes our strong internal low that broke the high. So if we want to play that M15/4-hour swing pullback, we've now got our bullish IBOS. This now becomes our strong internal low. Let's look for some M15 POIs to potentially trade from, right? So whenever I look for my POIs, I tend to just kind of start from the extreme, because typically that's going to be the highest probability, and look for the unmitigated extreme. Well, that's clearly mitigated. So let's kind of move it along to where we get the first unmitigated POI, and that would be this sell to buy here. It's had a slight mitigation here with this next candle, but it's kind of just efficient price action, right? The price just trickling out. It's not like we've had a clear movement away, pull back into it, and then filled up those orders and gone. So that's the clear bearish candle that gets engulfed. So for me, that's the POI. So that obviously led to an IBOS. So we know it's an institutional zone because it led to a break of structure. What's the next thing we can check? The next thing we can check is if it is a flip zone. So what do? We look left and we see where did that pivot in price, that pullback start from? That would be it. What did that react from? Do we have an unmitigated supply zone? Yes, we do. Okay, so this is your M15 supply that obviously led to the bearish IBOS here. Price came into that supply, it reacted, it moved to the downside, right? But it failed to do its job. It failed to form a lower low, failed to break structure, and then price broke and closed above the reaction point there. So technically your flip is anywhere from the top of the reaction to the bottom of the reaction, right? And that would be your supply to demand flip range. But we have just refined that to the single candle pivot zone. Okay, so bearish candle that's engulfed by the bullish candle leads to a break of structure. So now we know it's an institutional zone. Then we look left to see if there's a reaction from an unmitigated supply zone. Yes, makes sense. So we have a flip zone. What's the next thing we can look for? Did it sweep liquidity? Yes. All right, it's a subtle one, but you see how price pulled back, then broke the high, then came down and swept the low. So now we also have a sweep flip, even better. And it's then mitigated extreme and it's well priced. And we have a structural low there in front of it. So some potential leg inducement for this POI. So that's a pretty decent zone. But we also have this one above, right? This bearish candle here that also led to the break of structure. So just clear sell before the buy that gets engulfed there by the thrust candle. So two POIs there. Bottom one has a lot more going for it. It's a sweep flip, has inducement, unmitigated extreme, better priced. This one doesn't sweep liquidity, doesn't have any inducement. It did lead to an IBOS. Whoops, did it flip? Well, how do we know that? Let me just move this out of the way for a second. Well, we look left from where the pivot in price started. So it started here. Look left, what do we react from? Okay, we reacted from these wicks. So would there be supply in those wicks? Yes. So technically we have flipped that. So it is a valid flip. But if you're trying to judge it based on probabilities, the best flips are going to be ones that actually flip a fully unmitigated pivot POI, right? And the reason is because in here there should be a ton of orders, right? It's a fully unmitigated zone. So when price comes in and fills those orders, but then demand is strong enough to overpower all of that, that's a pretty good flip zone. Whereas here, it's only flipped the wick. So there's not going to be a lot of supply in the wick because if you actually look at the pivot zone, right, that was already mitigated back there. So this movement filled up a lot of the orders that then led to that movement. So we can say there's probably not a lot of supply left in the zone. It's mitigated. So really, that's just another question mark about how high probable is this area, right? How much supply did this zone really overpower? So for me, it hasn't really got a lot going for it other than it just broke there. So does that mean you shouldn't trade from it? Well, that's up to you, your risk tolerance and how much confluence you like. For me personally, especially in this sort of specific scenario, because we've just broken the M15 and the 4-hour lows, we've essentially kind of taken those, not really equal lows, but somewhat of a liquidity sweep there. But more importantly, we've had a clear shift in internal structure, a lot of momentum. This is around 7 a.m. GMT, so Frankfurt Open, European volume kicking in. Typically, price isn't always going to pull back that deep to get you that pullback. Sometimes it will literally just tap and start to fly at the start of the move, okay? So I'd personally be happy to trade from either of those POIs. So if this was a live market, I would set my alerts on both of those and then wait for price to come in. So we get our M15 mitigation. Let's just bring this back a little bit and drop down to our execution time frame, which in this case is going to be the M1. And my POIs aren't showing, which is great. Just make sure it should appear. Let's see. Okay, cool. So set your alert on your POI and wait for price to come in. Now remember, there was no inducement in the leg, right? One straight push. So what do we need to see for the liquidity entry model? We need to see a strong liquidation occur on the way back. So wait for our alert to go off. Okay, now we've got our mitigation. So if we need to wait for our liquidation, is there any strong liquidity that's been built and swept yet? Well, I can see it up here, it's a bit far away, but we have these equal lows, right? Price clearly came up, moved away, nice spacing between them, came back into that low, reacted, pushed away. That's definitely going to induce market participants to trade at that level, all right? And then those equal lows get liquidated. So if we draw our liquidation point across, okay, we can see there we get that liquidation. So how do we know if BFIs are using the liquidity below those lows there, the sell side liquidity, to enter their positions long and get long? Well, how do we know that? How do we say how nearby it is? Well, that's why the mechanical solution is to look for the PBL. What caused the liquidation of these equal lows, right? The liquidation occurs here, so we have to look up, and that would be your PBL, right? So some of you might want to mark these different color or something, or map it a different way to your normal zones, but that would be the PBL, okay? So we need to see that fail, as we know, for the strong liquidation entry model, right? Now, if you didn't have that sort of deeper understanding, or you went strict with that entry model, potentially you can now have a trade, because you might say, well, we've liquidated these equal lows, so that's a strong liquidation, true. We've had our medium time frame mitigation, good. V-shaped reaction, so just momentum coming in, that's what we want to see, that initiation out of the range, okay, good. We also have a chalk, okay, good. And what also do we have? We also have a flip, right? We've got your M1 supply there, price comes into it, there's a slight reaction, and then you get the chalk, okay? So on paper, what do we have? We have strong liquidation, medium time frame mitigation, flip, and a chalk, and a V-shaped reaction. So everything is there, and then you could potentially want to get long. And this is where I've been caught out loads of times in the past, and I would go, right, there's your trade. And then what happens, now we know the PBL holds, and you end up taking that loss. And that's why basically we recommend you use that in a century model. It is a bit more conservative, but it can really help you to avoid losses in these scenarios. But what's the logic behind it? We know that strong liquidity is going to build below those lows. So we think that BFIs could potentially use that to get long. But the way in which we know that they've used that liquidation to get long is we want to see the supply that caused the liquidation to fail, the point before liquidation to fail. And it doesn't, so it can potentially avoid you taking these sorts of losses. Okay? Now, I'm going to keep caveating that. At some points, if you have the high time frames are amazing, they're perfect, super high probability, high time frame POI, you've built the story, we've literally mitigated like the refine extreme within here, it's all systems go. That's when you might want to be a little bit less strict with your entry model, okay? But when you're bringing in discretion or bending your rules like that, use that for when you're more advanced and further down the line. When you're starting out, which will be, or trying to get consistency, which is probably the majority of you watching this, be super strict with this stuff, be mechanical. And there's a good argument to say, always be a super strict and mechanical, because if you're going to be doing this at scale, i.e. risking 100 grand or whatever on a trade, if you're trading, 7 or 8 figure accounts, do you really want to be second guessing or thinking, should I take this? The PBL hasn't failed. Probably not, right? You want to be mechanical each and every time. But yeah, this was just a good example where before you could go, right, strong liquidation, medium time frame mitigation, chalk, flip, V-shaped reaction, and then you wonder why you've taken the loss, okay? Now, this isn't always going to happen. Sometimes, right, price is going to come up and it's going to come in and go, and you're going to kick yourself and wish you're in a trade. That's just trading, right? The more confirmation you wait for, sometimes it's going to help you, sometimes it isn't. But over a large sample size of trades, you will test this to see if it gives you the edge that you want or not.